The market is shut. The screens are quiet, and silver is frozen around $79.25 after ripping roughly 10% in a single session. That one move is why phones are ringing right now in rooms you will never see on TV, because a 10% jump in silver isn't a volatility. It's a stress test, a solvency check. The kind of move that exposes who was leaning on leverage and who was quietly short a metal they can't actually deliver. And here's the problem for them. When the market closes, risk doesn't disappear, it concentrates. So while the public is eating dinner and scrolling holiday sales, the financial system is staring at the Sunday night open like it's a verdict. Welcome back. I'm your host, and this is the channel where we translate market noise into the mechanics underneath it. Fast, direct, zero wasted time. Now let's break down what this weekend really means, what the banks fear, and why the next gap could decide whether this is just a spike or the weekend the plumbing starts to crack. Start with one word. Wall Street hates margin. Silver isn't traded like groceries. It's traded through futures, options, swaps, layers of promises stacked on top of each other. And most of those promises are financed with borrowed money that leverages the whole game. At 20-to-1 leverage, a 5% move against you can erase your equity. At 50-to-1, a 2% move can do it. So what does a near 10% move do? It doesn't sting. It detonates accounts. Margin calls fire. Liquidations trigger. Risk managers flip from monitoring to emergency. Because the models were built for calm days, and silver just announced the calm era is over. This is why you're hearing about weekend risk meetings, not because the price went up, because the speed of the move implies someone got trapped. And in leveraged markets, a trap doesn't stay local. It spreads from the trader to the broker, from the broker to the bank, from the bank to the clearing system. And the clearing system is where things stop being a trade and start being a threat. Every major futures market has a central backstop that guarantees settlement. If a big player can't pay on Monday morning because they're short and the price exploded, the backstop covers the shortfall. That's the sales pitch. Don't worry, the system guarantees settlement. But guarantees have limits. There's a default fund, a pool of money built from member contributions. It's designed to handle a normal failure, a small fire. It is not designed for a stampede, because when the notional value of short exposure is measured in billions, a gap isn't a move, it's a bill. And if that bill starts to look bigger than the insurance pool, you get panic, not from retail, from the professionals, because professionals understand something retail usually learns last. In a clearing crisis, it's not about being right, it's about being paid. If participants start questioning whether the plumbing can settle trades, they back away. They stop quoting tight markets. They stop lending. They stop trusting. And when trust dies, liquidity vanishes. That's how you go from a metal rally to a systemic event. So when someone asks, why would banks meet over silver? This is why. Silver is small enough to be pushed around, but tight enough to snap back violently when the wrong side gets crowded. Now let's get even more uncomfortable. A lot of entities aren't short silver because they hate silver. They're short because it's part of hedging, carry trades, spreads, volatility selling, inventory financing, boring trades, until they aren't. Because the moment price moves fast enough, the boring trade becomes a death spiral. Margin is not negotiable. If you can't post collateral, you don't get a warning. You get liquidated. But what if the account being liquidated isn't small? What if it's a massive industrial hedger, a giant commodity intermediary, another bank? Suddenly, liquidation isn't cleaning up risk. It's tipping a domino. That's why weekends matter. Weekends are when institutions try to stop dominoes from falling in public. They coordinate. They call the exchange. They call regulators. They look for anything that buys time. And the rhythm is always the same. Friday, the move. Weekend, the meetings. Sunday night, the gap. Monday, orderly markets require temporary measures. So the real question is, what measures are on the table? Because when the system feels threatened, it reaches for the same playbook every time. Margin hikes, position limits, trading pauses. And the nuclear option, liquidation only. Let's go through them because this is where people get blindsided. A margin hike is the clean intervention. It looks like risk management. You raise required collateral. Leveraged traders are forced to sell or bring cash. Most can't bring cash, so they sell. That can slow a paper crowd. But it doesn't stop cash buyers. Industrial buyers don't care about futures leverage. They care about supply security. So margin hikes often just shake out weak hands and hand inventory to the strongest hands. Position limits sound fair, prevent concentration, but in a global market, they mostly relocate demand. Big money routes around restrictions through different venues and private deals. Trading halts can cool a stampede, or they can create panic. Because a halt teaches the crowd one terrifying lesson: you can get trapped. And when people fear being trapped, they buy harder when the market reopens. Now the reputation killer. Liquidation only, sell orders allowed, buy orders blocked. Yes, it can force the screen price down for a moment, but it also tells the world the venue can't handle real demand colliding with real scarcity. Once that credibility is gone, it doesn't come back with a press release. There's one more clause people ignore until it's too late: cash settlement. If contracts that are supposed to be deliverable suddenly settle in cash, the paper market and physical market officially divorce. You can't build electronics with a cash equivalent. So if you ever see settlement rules bend, understand what it really means. It means the paper claim is being honored with currency because the metal is the scarce part. And that's why the weekend is so sensitive. Because institutions can manage the paper arena with rule changes, they cannot control the physical arena with memos, they can't control dealer shelves, they can't control what premiums do, they can't control global flows, so they also fight a second war, the narrative war. Expect the same headlines to show up like clockwork. Regulators monitoring volatility, experts warn of a bubble, liquidity remains strong. They want you scared, because if you're scared, you sell, and if you sell, you become their exit. So here's a simple test. If this move is meaningless, why would anyone need an emergency weekend meeting? That's the tell. Now zoom out, because silver is tied to collateral, and collateral is tied to everything. When leveraged shorts get hit, they don't just accept losses, they raise cash, fast. How? They sell whatever is liquid. Stocks can drop, crypto can drop, even bonds can wobble, not because those assets suddenly became bad, but because somebody needs dollars now to meet margin now. That's how a silver squeeze becomes a macro story. It pulls liquidity out of the rest of the world to fill a hole in one corner of the market. And here's the pressure multiplier. Collateral values aren't stable. If bonds are shaky while margin requirements rise, the system gets squeezed from both sides. Collateral down, liabilities up. That's when funding markets get nervous, because funding is trust in motion. If banks stop trusting each other overnight, lending tightens, rates jump, and everyone starts asking the same paranoid question. Who's the one that's short? That is why central bank involvement rumors always show up in these moments. Not because they care about your coins, because they care about whether settlement survives Monday. But there's a cruel irony. If authorities inject liquidity to keep the pipes flowing, they expand currency supply. And hard assets tend to run when currency confidence is questioned. The medicine can become fuel. Now let's go where the paper crowd hates to look. The physical market doesn't read your rulebook. Dealers don't care about your futures margin. If they can't replace inventory easily, they raise premiums or they stop quoting. So watch behavior, not headlines. If screen price dips but physical premiums stay high, the dip is cosmetic. If screen price rises and premiums explode, the shelf is empty. That's the difference between a paper rally and a real squeeze. And this is where the weekend gets even more dangerous for anyone short. Because while New York is closed, the world still trades real metal. If physical prices in other hubs are higher than the frozen screen price, arbitrage wakes up. Traders see a simple math problem. Buy where it's cheap, sell where it's expensive. Close the gap. But to capture that spread, they have to buy futures or source metal tied to the Western benchmark. That buying pressure hits the reopen like a wave. This is why gaps are violent. Because of profit-seeking math colliding with thin liquidity, now layer on something most people miss. When the paper market tries to cap price, it can actually accelerate the train. If the screen is artificially low, every physical buyer globally wants to lift offers in the West and ship east to capture the premium. Metal leaves, inventory's thin. And the next squeeze becomes worse. So intervention can buy time and also steal the future from the people doing it. Now watch producers. In every commodity spike, there's a moment when supply hesitates. Some shipments slow, some contracts get renegotiated. Some producers decide they'd rather hold a little inventory than sell into a market they believe is repricing. Even small friction matters when inventories are already tight, because shorts can survive a high price for a day. They struggle for a week, they often can't survive a month. Which brings us back to Sunday night. The reopen is not just a number. It's a test of control. Liquidity is thinner on the reopen. Spreads widen. The book is fragile. That means price can jump simply because nobody wants to be the first seller in front of a train. Two scenarios. If silver gaps higher through $80, the weekend containment effort didn't slow the bid. Attention accelerates. Momentum algorithms engage. Media can't ignore it. If silver gaps lower, it doesn't automatically mean the squeeze is over. It can be intervention in thin liquidity, a shakeout. So don't just watch price. Watch volume and follow through. A down gap that is immediately bought with strong volume is not bearish. It's absorption. An up gap on heavy volume is not froth. It's confirmation the squeeze is feeding itself. Now, about levels. In fast markets, targets become psychological magnets. The first magnet is the low to mid 80s, then the mid to high 90s, then the fortress, $100. 3 digits changes public behavior. Searches spike. New money shows up. And when the crowd arrives, it arrives late, but it arrives heavy. Here's the twist. In the short term, higher prices can increase demand, not destroy it, because buyers who fear shortages hoard inventory. Companies don't say, it's expensive, we'll wait. They say, it's rising, secure supply now. That's how you get a demand surge on top of forced covering. That's how markets go vertical. Now let's talk about the shadow layer, because in every crisis, the first casualty is often invisible, not a household name. A leveraged fund, a commodity program, a market-neutral strategy that was neutral until the wrong correlation broke. When one of those blows up, it doesn't sell gently, it gets forced. And forced buying is the most powerful buyer on earth. It doesn't wait for pullbacks. It doesn't care about overbought. It buys because it must. That's why the weekend meeting rumors matter. If even one large short position is failing, the covering can cascade. Covering triggers price. Price triggers more margin. Margin triggers more covering. That loop is the squeeze. Now, if you're watching this and thinking, okay, but they'll just talk it down, understand the game. They can try to talk, they can try to scare, they can try to change rules, but they cannot manufacture metal, they can create paper, they can create narratives, they cannot create inventory. And when inventory is the limiting factor, the long-term winner is always the side aligned with scarcity. Now, let's get practical. What do you do going into Monday? Separate trading from positioning. If you're trying to scalp a violent squeeze, you're stepping into a machine designed to punish impatience. If you're positioned, your biggest risk is getting shaken out of a scarce asset for a plentiful one. Audit what you actually own. Physical in your possession is simple. You own it. Paper claims come with clauses, force majeure, suspension, cash settlement, redemption constraints. Read those words like your portfolio depends on them, because in stress events, it does. Expect the spread between screen and street to widen. That's not magic, it's risk pricing. In chaos, dealers protect inventory. Replacement is uncertain. Hedging is harder. Premiums rise. Measure reality by acquisition cost, not by a frozen quote. Now the first hour after the reopen. If it gaps up and you're adding, don't chase the first candle. Often you'll get a pullback from quick profit takers. If it never pulls back, that's information too. The bid is relentless. If it gaps down and selling has no follow-through, that's a failed shakeout. Those can reverse violently. But if you already hold a core position, the best move is often boring. Hold. Because in squeezes, the market's favorite trick is motion sickness. Up hard, up harder, down again. The purpose is not price discovery. The purpose is to make you quit. And here's the mental armor that keeps you from self-sabotage. Stop thinking in dollars. Dollars are not stable in a currency-stressed environment. Start thinking in purchasing power. How many ounces to cover essentials? How many ounces to buy a meaningful asset? That keeps you anchored while the screen tries to hypnotize you. Before we wrap, there's one more angle that turns a squeeze into a nightmare for anyone betting against it. Politics. When a metal starts behaving like a strategic asset, governments don't stay neutral. They start talking about supply chains, of national security, and critical materials, and that language has consequences. Producers see windfall profits, and politicians see a new target. You get taxes, you get export controls, you get temporary restrictions that somehow become permanent. And here's why that matters in the middle of a weekend like this. A paper market can pretend supply exists. A government decree can make real supply disappear overnight. If even a single major producing region signals tighter exports or heavier royalties, the forward market reprices instantly because the future stream of metal just got riskier. That's why the short side is terrified. They aren't just short a price. They're short a geopolitical roulette wheel. Now, the reopen. Everyone will stare at the headline price, but the smarter money will watch one number, the physical premium. If the screen says $79, but real-world bids are meaningfully higher, that spread is pressure. It's a coiled spring. It's the market screaming, the quote is not the price. And the moment global traders smell that spread, the reopen becomes an arbitrage event. Buying pressure shows up not because people feel bullish, but because the math is free money until the gap closes. So if you see a fast jump early, don't assume it's hype. It may simply be the market correcting a weekend mismatch between paper and physical reality. And if the system tries to cap it, that's the cliffhanger. Because capping the screen while physical stays bid doesn't end the squeeze. It moves it. It drains inventories faster. It forces the real price to migrate to whichever venue allows honest buying. And once price discovery migrates, it rarely comes back. So here's the real question going into Sunday night. Do they let the market clear, or do they try to control it one more time? Either answer is bullish long-term, but the path, the volatility, and the speed will be completely different. Now, I want to hear from you in the comments, because the ground truth matters more than the headlines. If you tried to buy physical today, what did you see in stock, delayed, or sold out? And what do you think they try first on Monday? Margin hike, position limits, or a volatility halt? Your answers will map the real market, not the paper story. So here we are, market closed, silver frozen near $79, weekend meetings rumored, and the quiet isn't peace. It's preparation. If the reopen prints above $80 and starts marching, you'll know containment failed. If the reopen tries to smash and premiums refuse to fall, you'll know the paper game is losing its grip. Either way, this weekend is a checkpoint. A moment when the system reveals whether it can absorb pressure or whether it has to bend rules to survive. And if it bends rules to survive, that's not strength. That's weakness. If you want the real-time breakdown as this reopens and the first rule changes, hit the tape, subscribe now. Short, simple, and you won't miss the moment the market